Arrives in Europe today. And Angela Merkel demands answers from Russia after German medics conclude Putin critic Alexei Navalny was probably poisoned. Matt.
All right, let's take a look at European equity index futures right now, heading higher ahead of the open. We see U.S. futures pointing to a higher open on this Tuesday as well after the gains that we saw to kick off the week yesterday. By the way, the U.S. equity index is at new record highs again after rising for 4 weeks in a row. Let's take a look at the global macro movers screen on the Bloomberg. It shows us assorted risk assets, but the left-hand column is equity indexes. These will pop out as they open up across Europe. You can see the FTSE already open, up just about 0.1%. The OMX in Stockholm is up about 1/3% right now. And as you see, other European equity indexes opening up. Futures were pointing higher for all of them across the board. So you should see green arrows across here. The AEX in Amsterdam up 1/3%. The CAC 40 in Paris up 1/3%. The DAX here in Germany up 0.6%. So European markets are solidly higher in the cash trade. That's amid optimism about coronavirus treatments and signs of progress on trade negotiations as well after, as I said, another record close on Wall Street yesterday. Joining us now is Paul Markham, Newton Investment Management Global Equities Portfolio Manager. Paul, we're driven to ever higher highs in New York, while here in Europe we're still, for the most part, down 10 to 20% year to date. When are we going to catch up?
Well, it's probably dependent, Matt, on some kind of sector rotation, because the European markets in general have much less technology in their makeup, and more what you might call cyclical style stocks, quite a lot of them fairly cyclical in that value sort of space. And I think that the problem for European indices as a whole is that until that kind of whole cyclical trade comes to the fore, it's going to be quite hard to see them moving up a lot higher. We've also had a headwind, particularly for the Eurozone, which is that the Euro's been very strong, and quite a lot of the European markets are made up of companies which are quite global in nature, so they like a weaker currency. So I think both of those things may have to alleviate a little bit before we can see a catch-up trade take place.
And let me ask you about the German market. Paul, good morning. Very good to have you on the programme. All of that said, it's really interesting to me that the DAX actually not that far from being flat year to date, whereas other European equity markets, the FTSE and the CAC 40, still down by 18 and 15% respectively. So it seems as if the DAX is a real outperformer. Do you put that down to better handling of the virus? Is it to do with exposure to China and the economy there? Where do you see the distinction? Because some of those old economy names sit on the DAX as well.
Yeah, they do, quite a lot of them, and although they tend to be quite mid-cap in nature, there is a sort of greater degree of confidence around the way the German government has handled the crisis. But I think that really it's some individual stocks which have done well. Let's not forget that 2 of the largest 4 tech names in Europe sit in Germany, which, although it's not a complete game changer, does help the index as a whole, and it doesn't have much exposure, if any,
Morning, everybody. Join us for a live trading session. Follow us for free, copy our trades, and make some profit. We trade live our own funds in front of our clients so they can see how profit being made. What we show you this week, we show you only one screen of our trade station. You see 5 pairs. You will see Japanese yen, British pound, Canadian dollar, euro, and Bitcoin. All pairs we trade live in front of you, so you can trade us live. You can use your own broker. You don't have to open with us broker. You can just follow our trades, copy our trades, and make profit with us. In our case, we have 1 pip equals 100 pounds, except Bitcoin, where 1 pip equals 10 pounds. At this moment, I'm looking to euro, and I'll let you know if it will reach the certain price. I will place an order to sell short, but not yet. So follow us and see when we're going to do this.
When it comes to discretionary items, employment is a big question mark here, and if you don't have a job, or if you're worried about your job, you are less likely to replace your car, even though financial conditions are very easy. So if you are in a position where you feel that you can finance a new car, you can get that finance very easily, and you should be able to get a really attractive interest rate and so on. I think the other thing which is really starting to become a once-in-a-generational headwind for the car makers is EVs. And although we know that some of the biggest players, some of among them the big German players, have very visible and strong product plans for their electric vehicle ranges, the key here is whether or not the consumer will go back to buying one more internal combustion car before he or she then decides in a few years' time to trade that in for an EV. And there are a couple of really big, significant swing factors in that, of course. One of them is how far the price of those start to come down, because what we all know with new product launches in any area, particularly technologically related product areas, is that it takes a few years for the price discovery to come through. The second is the infrastructure and the ability to charge them. And let's not forget that in the largest cities, where the biggest impetus to convert to EVs is, many people live in apartments, and it's difficult to find the parking space which has the ability to charge, and you can't charge it through a cable from your window or on your driveway, for example. And then, of course, there's the question mark of the attractiveness of products, and that's something where the individual car manufacturers will have their own questions to answer. So I think there could be a kind of lull period, if you like, a kind of interregnum, where it may be a little bit uncertain as to whether or not the consumer will bounce back into buying autos in the way they have done in previous cycles.
And Paul, if we need to see a bounce back in autos for Europe to really do well, if we maybe think about other sectors that Europe is really strong on, and one of those is financials, do you see value making a return? The financials not playing the same role in this crisis as they did in the global financial crisis, of course, more than 10 years ago now. Is there room to see a pickup in bank stocks?
Well, the positive side, Anna, it's certainly true that the banks are lowly valued. They have lagged on a multi-year basis. For the last decade, they've been appalling performers. And they're much better capitalized than they were, as you say, in 2008, 2009. Their role in this is not the same. And the opportunity for redemption is kind of there, really, for the banking sector. And as they, are encouraged by governments and their regulators to come to the rescue to some extent with some sort of sense of loan forgiveness, government-driven programs to encourage lending into the economy. I think the big question marks over them are firstly the level of interest rates. And European banks tend to be dominated by what you may call balance sheet style businesses lending on a spread, rather than facilitating debt, which is what tends to be the road to market much more commonly used by US banks when it comes to funding corporates. So that's a big question mark. And of course, there is the sort of loan quality question, which is that as the economy starts to suffer in the post-pandemic period, you may well see some very difficult conditions, particularly around corporate bankruptcies and the quality of the loan book. So I think that those things will tend to encourage investors to be quite cautious around them. If we had a reflationary environment, though, of course, that would benefit them from a balance sheet perspective. Their loan books would look a little bit less stretched, and of course their pricing would improve and spreads would widen as well. So I think we would probably need to see some sense of reflation.
Paul, thanks very much. Paul Malcolm, Newton Investment Management Global Equities Portfolio Manager. He stays with us. More from Paul in just a moment. In fact, up next, we'll get some of Paul's top calls. I'm busy watching gains across European stocks. Stocks Europe at 600 extends early gains, testing its 200-day moving average. So a strong picture for European equities, up by more than 1% on a number of them. Watching the DAX very closely as it sees if it can get back into positive territory year to date. This is Bloomberg. Welcome back to the European Market Open. It is 12 minutes past 8 here in London, so 12 minutes into your European trading session, and we're making some really decent gains, in particular the DAX and the CAC, both up by more than 1%. In fact, the IBEX and the FTSE MIB likewise. Let's get the Bloomberg Business Flash for you, some of the top corporate stories we're covering today on the Bloomberg. Virgin Atlantic is set to find out if it has enough support from creditors for a £1.2 billion rescue. It's already won the backing of 3 other creditor classes and now has to convince suppliers. If they vote against the plan, the airline can take it to a judge to overrule them. Tiffany and LVMH are extending their deal deadline by 3 months. That's according to Reuters. It gives the French luxury giant until November 24th to conclude its $16 billion purchase of US jeweler Tiffany. Both companies have been hit hard by the pandemic, but LVMH has previously said it expects a gradual recovery this year. Apple has been spared from having to immediately reinstate Fortnite to its App Store. It's an early court victory in its battle with Epic Games, but it wasn't a total loss for Epic. The US district judge has granted the company's request for a temporary order blocking Apple from limiting the developer's technology being used by other apps. That is your Bloomberg Business Flash. Matt?
All right, now speaking of Epic Games and the Unreal Engine, let's talk about tech. Dominance of the sector is shaking up the Dow Jones Industrial Index. Exxon, Pfizer, and Raytheon were kicked out of the index in the biggest reshuffle in 7 years. Those three make way for Salesforce.com, Amgen, and Honeywell, who take their places next week. Paul Markham, Newton Investment Management Global Equities Portfolio Manager, is still with us. And Paul, I mean, does this tell you, because I know you've stuck with an overweight in tech, that the industry, that the sector still has legs in terms of the rally?
It does feel that way, Matt. I'm certainly, we'd expected there to potentially be a bit more of a rotation on a short-term basis into the more value-style areas, and we thought that those tech names would be victims of that. What we've seen, however, is a market which has started to slightly lose that focus on growth versus value, and we've just started to see a market which is a bit more constructive over equities in general. And the other thing which I think is important here is that we have a couple of the biggest names in the sector doing stock splits. And at a time when the retail investor has become quite prominent, and day traders and so on, particularly in the US market, that can be quite influential as they can now start to trade in smaller size some of those big tech names which they want to get exposure to.
And on that front, Paul, we were hearing from Leon Cooperman, a hedge fund manager, overnight, and he was sort of laughing or mocking the fact that we saw an increase in the value of companies that do stock splits, because he was saying, you know, it doesn't increase the value. But to your point, does the fact that it makes it more accessible then to day traders, does it increase the pool of investors and therefore does add to the value of a business?
Yeah, absolutely. I mean, you know, we tend to think of day traders as guys who literally hold stocks for, you know, a day or less, or, you know, very short periods of time. But they quite often have a portfolio approach. They will own several stocks. And that being the case, it's, you know, quite challenging for them to own chunks of the portfolio in stocks which trade at thousands of dollars per unit. And so, you know, as the weight of the day trader and the amount of volume going through markets has been pretty high from the retail investor, it's therefore important that some of those big names are accessible to them. And it also, of course, just opens up new interested parties for the investor register, and it's not just institutions. And so, of course, you know, that being the case, you have more parties looking at your stock and more guys that are likely to buy you. So yes, it certainly does make a difference. Of course, the point is a very strong fundamental one, that it makes absolutely no difference to the fundamental value of the company, but it does increase the net that can be used to capture investors to buy your equity.
Yeah, absolutely. Although it doesn't hurt. I mean, I was thinking about this last night, Paul, and looking at Honeywell. Its shares have gained 10 out of the last 11 years. So, you know, after it was kicked off the Dow, it still continued to do well, and now it's joining back up again. I wonder separately what you think about inflation, Paul, because it's been such an interesting question for bond investors. And of course, it's helped, you know, fears of inflation, at least partly, gold to rally. What are your expectations for inflation, and how do you think stocks will do as a safe haven for inflation?
Well, stocks will generally react well for the short to medium term in an inflationary environment. The only inflationary environment they don't like, of course, is a stagflationary one, which is not really a particularly attractive outcome for anything other than probably gold or maybe index-linked bonds. Certainly the chances of there being a reflationary outlook have been attracting quite a lot of attention in markets over the last few months, and we've had a couple of prominent commentators say that they thought we were returning to a reflationary environment. Of course, that is what the authorities want. The ability to inflate away debt is quite useful, and it's always very tempting as an economic policy. And we saw it implemented in the late 40s and through the 1950s as a way of trying to inflate away the debt which came around as a result of the Second World War. In this particular situation, we have passed a phase where there's been an unprecedented amount of change in terms of consumer behavior due to technology. And of course, that's a very disinflationary force in the sense that the consumer can see pricing very easily. But that may be normalizing. And as that happens and we have a wide monetary base and a lot of fiscal stimulus coming through, that could well be the environment for inflation to pick up. And let's not forget that over the standards of the last 10 years, a pickup in inflation of a relatively modest nature could still be quite significant for markets. So I think equities, and particularly value equities and financials, will probably quite like that environment, as well as the usual suspects in that sort of scenario, which are emerging markets and the sort of commodities suite as well.
Okay, yeah, interesting. You're talking there about a modest pickup in inflation then, though, Paul. Let me ask you about the airline sector. This, I noticed in your notes, you had a really interesting take on in terms of defining what we mean by a fragile business model. Do you think that post-coronavirus, we will, when we look at stocks to invest in, we will put them through a new filter, if you like, and balance sheets will just have to be a lot tougher into the future for this particular sector and maybe for others as well?
Yes, absolutely, and I couldn't agree more. The fact is, this whole episode has reminded us just how many businesses live almost hand to mouth, and without a few months of free cash flow, they really are in a very bad position. And the balance sheet size of the airlines and the intensity of capital they need to operate is very significant, and the returns they make on capital are pretty low. And so as soon as you take away the ability to sweat the asset, so therefore being able to sit a certain number of people within every square foot of an airliner, the business model really doesn't stack up. And so what we're likely to see, I think, as a result of that is higher prices, which are going to be a necessity. We're going to see a situation where nation states will continue to want a flag carrier, and I think that's going to be something which is seen as integral to a country's credibility as a business nation, being open for trade. On the other end of that, some of the value airlines that are stronger in terms of their benefits of scale and existing franchise could do quite well. I think the guys in the middle could well get squeezed because they don't either have the ability to turn around their planes very quickly in the way that the budget guys do, but at the other end, they don't have the flag to wave and that kind of implicit support from governments to keep them operating as a flag carrier. So I think we will see some shakeout in the number of operators in the industry because it very soon becomes quite a distressed situation if you don't have the right revenues coming in from your passenger base.
Paul, thanks very much. Thanks for your time this morning. We appreciate it. Paul Markham, Newton Investment Management, Global Equities Portfolio Manager. Paul will be continuing his conversation with us on Bloomberg Radio. That's at 9 a.m. UK time. 8:21 here in London. Coming up, Germany demands answers after doctors say a prominent Putin critic was likely poisoned. We bring you all the details next. This is Bloomberg. Welcome back to the European Market Open. A German medical team determined that Russian opposition leader Alexei Navalny was likely poisoned. The Putin critic was transferred to a Berlin hospital after falling severely ill last week. His supporters suspect poison was placed in a cup of tea he drank at the airport in Tomsk. With us to discuss is Bloomberg's Maria Tadeo, who's been following this from the European angle, from Brussels. Maria, good morning. Where does this escalation leave Russia's relationship with the West, with the EU?
Well, and I think what it shows is that having a normal or a more normal relationship with Russia is going to be very difficult at this point. And until now, we had heard from Emmanuel Macron, the French president, say that, the relationship had to be reset, that Russia is still an influential global player. But of course, if anything, this is going to once again reignite the talk about extending and perhaps more sanctions on Russia. In particular, when you look at Angela Merkel yesterday, the tone was very severe. She said they need to come up with answers. They need to be very transparent on this, and the Russian government needs to cooperate. But the problem for Angela Merkel, of course, is that there is a very complex business relationship with Russia when you look at gas, when you look at the Nord Stream pipe. And this is not just a political story for Germany, but there's also this transactional aspect that makes the relationship with Russia so complex.
Yeah, absolutely. I mean, Germany wants to pay Russia hundreds of millions of dollars for its natural gas, and the question is, what does that go to fund? What does that allow Putin to do that money? What should we expect next from the European Union after the hospital here, Charité, one of the best hospitals in the world, says the tests show Navalny was poisoned?
Yeah, for sure, the European Union is going to take this very seriously. And of course, they're going to take this German line that there is now evidence that something here happened that shouldn't have happened. What is interesting, and we're probably going to find out about this at the midday press conference in Brussels, is whether or not the EU feels they need to escalate this. That this is not just a story that is concerning Germany and Angela Merkel. Of course, this is happening because he is in a hospital in Berlin, but whether they feel that this does merit a bigger European investigation going into Russia. And of course, it'll be interesting to see whether the language changes, whether they say, Vladimir Putin, once again, it's clear that he is not a trustworthy partner. And again, this idea of potential sanctions.
All right, Maria, thanks very much. Bloomberg's Maria Tadeo there out of Brussels. Coming up, Wizz Air wants to expand its new base at London's Gatwick Airport from just one plane to 20 within Welcome back to Bloomberg Markets. This is the European Open. We are 30 minutes into the trading day right now, and we're looking at gains across European equity indexes. Let's take a look at the broader benchmark. This is the Stoxx Europe 600. You can see the gains about 0.75%. And if you, well, with any index, you can type GRR and you can see the group ranked returns, and that shows you which sectors are doing the best, which sectors are doing the worst. If you try that with the Stoxx 600 index, and let's go ahead and pull that up. You can see the travel and leisure stocks are doing the best. This is fitting since we're about to talk to the CEO of Wizz Air. Banks and insurance are up there as well today, but really all of the industry groups and are showing gains on this Tuesday.
Yeah, absolutely. Really interesting to see the extent of those gains and watching whether the DAX will turn positive for the year to date. Let's get a Bloomberg First Word News update. Some of the top stories we're covering here at Bloomberg. Both the US and China are seeing progress under their Phase 1 trade deal and are committed to its success. Senior officials from the two sides held discussions to review the 6-month-old agreement. The US says they discussed steps China is taking, including greater protection for intellectual property. Beijing is still a long way off meeting its promise to increase purchases of US goods, though. President Donald Trump has officially been nominated as the Republican candidate for the White House. The president and his supporters used the first night of the party's national convention to defend his response to the pandemic. The administration has been criticized for failing to do more to combat the virus, which has now killed more than 177,000 Americans. Israel's coalition has narrowly averted collapse. That's after its lead partners agreed to extend the midnight deadline for approving the national budget. If Prime Minister Benjamin Netanyahu and Defense Minister Benny Gantz hadn't pushed the time limit, Israel would have faced its fourth election in 18 months. After hitting the Caribbean, Tropical Storm Laura is poised to become a powerful hurricane. It's due to make landfall on the U.S. Gulf Coast on Thursday. An alert has been issued in parts of Texas and Louisiana. Another storm, Marco, has lost so much of its power it's weakened to a tropical depression. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Matt.
All right, now let's talk Wizz Air. The company wants to expand its new base at London's Gatwick Airport from just 1 plane now to 20 within a year. That's if the airline can secure enough takeoff and landing slots. Wizz Air is seeking to leverage the European airline industry's lowest cost base to grab market share in London. Of course, the coronavirus has pushed other carriers to trim their fleets, and Wizz Air has complained that a lot of the incumbent carriers are blocking slots, even though they don't intend to use them. Let's ask Joseph Verratti, the CEO of Wizz Air, about this right now. Joe, you told our own Chris Jasper in an interview that you want to aggressively expand at Gatwick, but that incumbents are blocking up spots unfairly. Do you think you'll be able to get those slots?
Good morning. I mean, certainly this is what we are pushing for in the UK as well as at European Commission levels. We think it is unfair and it distorts the market. You know, should the slot waiver get further extended into the winter period? As you know, there is a slot waiver right now for summer, and we think it should firmly end at the end of October, and the market should decide who takes possession of these slots, and it shouldn't be decided administratively or politically.
Yeah, there's a use it or lose it principle behind this, Joseph, but it's a complex web of sort of EU regulations and IATA protocol. Who are you talking to try and get the slots and the rules around them changed?
Well, at this point in time, this is a decision imposed by the Commission, the European Commission. So we are talking to the European Commission, but we are also talking to national authorities in various countries, including the United Kingdom, and certainly we are also approaching politicians. If you think about this, I mean, an airport is a public property, and the rights to use the airport should not be privatized to airlines. For the sake of possessing those slots without any intention to operate them. If they can't operate, then I think those slots should be returned to the pool and new airlines should be rewarded with them.
Can you Confirm a ballpark figure of how much you want to expand, Joseph. I mean, you told Chris 20 planes at Gatwick within 6 to 12 months. What's the bigger picture expansion look like to you?
That's correct. I mean, if you look at our operations in London at this point in time, we have 11 based aircraft pretty much flying outbound traffic from London. We have around 22 airplanes coming inbound into London. So we would be looking at doubling that traffic over the course of the next 3 to 4 years. And as said, within the first 6 to 12 months, we would be ready to deploy around 20 aircraft should we be getting access to the airport at Gatwick.
Would a good strategy for you, Joseph, be to buy up failing airlines? Do you see any that you're interested in at this point?
Possibly, but I think it would be fair that if an airline decides not to use or is not able to use the slots, those slots should be returned to the market and should be reallocated free of charge. But of course, we would be also ready to consider the transaction.
So in expansion mode, I'm assuming you don't have to cut any jobs. Have you had to during the coronavirus pandemic at all? Do you plan to do any kind of restructuring?
We did at the beginning. We had to address the current weakness resulting from coronavirus. I mean, we had to take capacity significantly down, and that's resulting in less labor requirements for running the business. But we would be looking at adding that labor component back to the system, and we would be rehiring those people who we laid off pretty much on a temporary basis earlier this year.
Can you quantify, Joseph, how many jobs you had to cut and how much you want to build back up?
Yeah, so on a total company basis, we laid off around 1,000 individuals, pretty much none in the UK. I mean, the UK remained totally intact during coronavirus times, and we are running at full capacity in the UK as we speak. But on a total company basis, around 1,000 people, and we would be looking at rehiring these people going into the beginning of next year. So in the next 5 to 6 months, we should be in rehiring and recruitment mode.
I mean, this seems quite amazing. How are you able to run at full capacity in the UK? How are you able to expand so much as others are considering bankruptcy? Is this a reflection of your balance sheet, your route network? Why is it that you seem to be operating in different conditions to other airlines?
Well, first of all, I think we are not immune from the current crisis. Our business is affected by the pandemic, but mostly by the measures imposed by governments making travel quite unpredictable due to all these restrictions coming and going. But at the same time, we have maintained our views on the future, and we are also looking at how to cut through the jungle and how the market will work out for us post-pandemic. And it's not only that we are saving and cutting and moving capacity around short term, but we are certainly looking at the long term, and we are investing into new market opportunities. The UK in particular has been very strong for Wizz Air. We are the lowest cost producer in the marketplace. We have a very balanced traffic, flying people inbound, but also flying increasingly Brits outbound. And our very efficient business proposition has made a lot of sense to the market, and we are becoming more and more the preferred carrier in the UK as a result.
When you see competitors bailed out or allowed to restructure, I'm looking at the Virgin story today. Do you think this market is running with an amount of competitive fairness that makes it a level playing field, Joseph?
But we are clearly seeing two major issues here. One is that level playing field has been distorted by governments by injecting a lot of financial resources into the industry, and now more and more we are seeing governments becoming equity holders in airlines, and that has never been good because governments become double-minded. They don't only regulate the market, but they are also having a particular interest in one of the players, and that is not right, and this is not good for the industry. And secondly, we are seeing some other administrative measures being played into the game, like this slot waiver measure, which is really just preserving the status quo, preserving the inefficient incumbent carriers, basically eliminating the opportunity from newcomers, more efficient airlines to come to the market and compete it out. So we are seeing actually quite some issues endangering the marketplace, distorting the market, and putting pressure on the level playing field here.
You know, the argument, Joseph, from governments is that the incumbents that they bail out will continue to provide legs, you know, between destinations that maybe aren't as profitable as, or those legs that wouldn't be filled.
I'm placing a new order to sell short British pound at 130.97. New order, please. Short to sell at 130.97. All right.
The operation of that capacity. I think the real difference between us and the incumbent carriers is that we carry a passenger at the third of their cost, and simply they are unable to compete with us, and as a result they become.
New short position opened for British pound at 130.97.
Experience, and they don't want to be ripped off. And there are ways for governments to make sure that, you know, the country's interests or their political interests are fulfilled by procuring on a public basis. And we could be one of the contenders. As a matter of fact, we are doing it in Hungary.
Thanks very much, Joseph. Really good to speak to you. Joseph Faradi, the CEO of Wizz Air. 8:41, 8:42 here in London, 9:42 if you're in Paris or Berlin. Coming up, it's a positive session for European stocks this morning. The year of the day trader, perhaps, is upon us. We take a look at the surge in retail investment around the world next. This is Bloomberg. Welcome back to the European market open. 45 minutes into a positive session for European equity markets. We're off our highs of the session, but still up by almost 1% on the CAC 40, and not far off that on the DAX. It's 2020, the year of the day trader. Bloomberg Intelligence now estimates that retail investors are the second largest segment in US trading markets, with a 200% surge in trading volume year on year. Simone Foxman joins us now from Doha, and she's been looking at this story. Simone, good morning. This isn't just, though, about the US. There's some more global reference points here. How substantial is this surge of retail enthusiasm around the world?
Yeah, good morning. Well, for just an example, I take you to China, where we are seeing new brokerage accounts opened at the fastest pace since the stock bubble back in 2015. And if you look at July, there were 2.4 million new brokerage accounts opened, and we've seen a surge 6.5% this year. But honestly, I could tell you about this rise of retail investors in so many markets around the world. We could talk about India. We could talk about the UK, where Hargreaves, AJ Bell, both saying they've seen a lot of brand new accounts. We could talk about Schwab. We could talk about TD Ameritrade that also say they're seeing new accounts. And we could talk about the huge surge in Asia trading volume. This thought to be caused by retail investors, just indicative of how much of an effect they're having on the composition of the markets.
What do we know, Simone, about where the retail money is going?
Well, we know it's coming out of bank accounts. So look at Turkey. It's going out of accounts that are earning essentially negative real interest rates, and it's going into a couple of things. So Bloomberg Intelligence, in their assessment, did an analysis of the things that retail investors like. They like low profitability, they like high volatility, and they like cheap stocks. So you were talking with Paul Markham earlier, and he was bringing up all those concerns about the airlines. Well, those are an example of the low profitability names that Robinhood traders have gotten into. This is also behind some of the surge that we have seen in these smaller cap indices. US, China, and Japan are all good examples to look at that have really surged in comparison to the country benchmarks.
Thanks very much, Simone. Good to speak to you. Really interesting story, certainly one that's dominated a lot of the thinking stateside, but increasingly global, as you suggest. Let's take a look at some of the movers that are moving European equity markets then to the upside. We've got Aviva gaining after its takeover of Osisoft at an enterprise value of $5 billion. Danske Bank, an American judge has thrown out a lawsuit alleging the Scandinavian bank deliberately hid its involvement in money laundering, so that's having an impact. LVMH in the luxury space, Reuters is reporting that the deadline for the Tiffany deal is being extended by 3 months. So all of that adding to movement in those share prices. Matt?
All right, coming up next, from Brexit and gold to the EFO survey due in just under 10 minutes' time, we're going to talk about the factors moving markets with the Market Live team's Richard Jones. Next, this is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 50 minutes into the session and looking at gains of 1% on the CAC 40, the FTSE 100 in London, up about 35 points to 6140. Let's take a look at what's moving markets across asset classes with Richard Jones. He's our MLive FX and rate strategist in Berlin. And Richard, you know, we are seeing gains in equity indexes, but the FTSE is really a huge laggard when you look across its global competitors. And you've got the furlough scheme about to end, as you're writing about on the MLive blog right now, plus Brexit coming up, and it doesn't look like they're making any headway there. Are we going to continue to see cable at 131?
Well, Matt, I think that the end of the UK government's furlough program and the bleak prospects for a Brexit deal are going to come together in the autumn to provide what I would describe as a really challenging backdrop for the economy and for the pound. I mean, we've got vanishing jobs and empty office spaces already damaging the country's recovery prospects. And I think that's currently weighing on consumer confidence. I think that's going to get much worse in the coming months. I mean, on Brexit, I think the messaging that we got last Friday from both sides was incredibly downbeat. You had both the EU and the UK blaming each other for a lack of progress in the negotiations. The EU concluding that that striking a deal on the future relationship seems unlikely. The UK said the EU's approach makes it unnecessarily difficult to make progress. To me, this points to the current transition period ending without a trade deal, and I don't think that's going to be good news for the pound. And then on unemployment, I think there's what I describe as palpable and very well-founded fears that unemployment is going to spike in the autumn when the government's current furlough program ends. It looks like Rishi Sunak is not keen to extend the plan that is currently protecting millions of jobs. So what I think this means is that when the program ends, the full extent of the pandemic's damage to employment in the UK is going to be a lot clearer. I think it could present a potential cliff edge for households in the UK. I think this and the lack of a Brexit deal is going to mean that the pound is going to fall considerably from current levels.
Good morning to you, Richard. And so the Brexit conversation and whether we get a trade deal is still relevant for UK assets, is it? Because so many other things, much bigger things, seem to be happening in the UK economy right now. But I suppose relative to other economies are also experiencing COVID-19, but they're not trying to renegotiate trade deals with their largest trading partner.
Yeah, I think you just hit the nail on the head there, Anna. I think that COVID is such a massive challenge for policymakers everywhere around the world. They've really got their plates full in trying to deal with the economic and public health impact of the pandemic. If you add renegotiating trade deals on top of this with your biggest trade partner and with others, I think it just becomes too big a problem. And I think in a relative sense, I mean, currency markets very much are relative valuations. And I think as a result, we'll see the pound suffer against other currencies because the public policy, the amount of public policy challenges that are facing the UK are really too much, will really be too much in the coming months.
I keep thinking back to Anna sent me a John Authors column this morning talking about the K-shaped recovery, and of course, that's kind of the hot word for economists right now, or the hot shape to talk about in terms of, you know, the inequality, a gain for some groups of people, some groups of stocks, some regions, and a loss for others. And the interesting thing I thought really was the outperformance of China. Of course, Authors is writing about the equity indexes, China versus other emerging markets and the rest of the world. But I wonder what it looks like from a rates and currency perspective. I mean, do you see that inequality there as well?
Well, I think one thing that we need to really get our heads around, and I think that PIMCO had made this point within the context of sort of a broader view on gold, is that the current lower for longer rates posture that we're seeing everywhere is something that we're probably going to have to get used to for at least the next 5 years, if not longer. I think real rates are at record lows. That's not going to change anytime soon. As a result, I think you're going to see different winners and losers across the globe. And I think that in the currency space, I think that if I look at what Europe is doing, I don't think they've dealt perfectly with the pandemic, but I think they've taken a slightly more proactive approach than what I've seen in the UK and the US. And so I think in the coming months, we'll probably see the euro continue to do well. It's well off the lows that we saw in March. I think it'll continue to do well against the dollar and the pound because I think the way public policy policies approaching the pandemic is slightly more joined up than what we're seeing in the UK and the US.
Richard, thanks very much. Thanks for joining us. Richard Jones, our Markets Live FX and rate strategist in Berlin. Remember, you can get involved in our question of the day. Every day we pose one. Today was around sensitivity to COVID-19 and a vaccine. Reach out to us. Use the function IB plus TV Go on your Bloomberg. That'll get in touch with the TV and the Markets Live team. That's it for the European Open. Stay with Bloomberg Television. Up next is Surveillance. They will continue to follow the strength in these European equity markets for you. This is Bloomberg.
Committed to success, U.S. trade negotiators say both Washington and Beijing saw progress in talks. Equity markets continue to rise. Trump on the defensive. The president stands by his handling of the coronavirus on day one of the Republican National Convention. Nikki Haley says the Democrats are still blaming America first. A German slump. Europe's biggest economy shrank 9.7% in the second quarter. We'll talk the outlook for the recovery with the IFO Institute shortly. Welcome to Surveillance. I'm Yusuf Gameldine in Dubai. We've got hopes of progress on terms of a vaccine, and then at the same time signals that they're making progress when it comes to the U.S.-China trade tensions, and both of that really firmly supporting the risk rally we're seeing in a lot of these key asset metrics. Let me show you the state of play with the stock story in Europe at the moment. We're up 0.5%. It's a similar story in terms of the S&P 500 mini. We're coming off the back of record highs in U.S. stocks, but the good times might not last, according to Morgan Stanley. They're saying the market is vulnerable to shocks, especially rising rates, and the first tradable correction could begin imminently. Treasuries are on the back foot as we speak. We are looking at a week of greenback, halting a two-day gain. Your euro dollar is at 180.30. We are up 0.2%. And then gold is at $1,935 an ounce. Perhaps a little bit of, a strange one here, given the wider risk appetite here. But the folks at PIMCO saying that the gold rally isn't played out yet. And despite the recent run-up in gold prices, they believe gold remains attractively valued, especially in the context of low real interest rates. Let's get to the Bloomberg First Word News now for you. Here are some of the stories we are watching. Both the U.S. and China are seeing progress under their Phase 1 trade deal, and they're committed to the success of that. Senior officials from the two sides held discussions to review the 6-month-old agreement. The U.S. says they discussed steps China is taking, including greater protection for intellectual property. Beijing is still a long way off, though, in terms of meeting its promise to increase purchases of U.S. goods. New York is investigating if President Donald Trump's company falsely reported the value of his assets to secure loans and tax benefits. The probe was triggered by the president's former personal lawyer and fixer, Michael Cohen, who has fallen out with his ex-boss. He handed Congress a series of Trump's financial records from 2011 to 2013. No comment, though, from the White House. Chancellor Angela Merkel is demanding full transparency from the Kremlin over the case of the Putin critic Alexei Navalny. A German medical team has determined the Russian opposition politician was likely poisoned last week. The Berlin hospital says he is in a serious condition and may suffer long-term damage. Global news, 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Let's get you some breaking lines coming through from IFO then. The key line being the August German Business Confidence Index at 92.6. The market had penciled in 92.1, so a marginal beat then for the IFO August German Business Confidence line. Let's get straight to some additional context here. We are, of course, joined by some of the key voices leading some of the research. We had the German GDP on earlier, and we're now joined from Munich by the IFO Institute President, Clemens Fuest. Clemens, welcome back to the show. So, I mean, based on the indicator we got from the German GDP figures just moments ago and now from your survey as well, is the recovery stalling, would you say?
I would say the recovery is more or less on track. So the GDP figures are slightly better than the ones we had a couple of weeks ago in the revision, and the climate index, the business climate index, continues to increase, to recover. This time, it's not just the expectation, it's really the current situation that's improving. We're still far from normal, but the recovery, I would say, is on track.
What about the labor market? I mean, over the summer, tens of thousands of jobs have been cut. Is that going to continue?
Yes, I'm afraid we'll continue to see job cuts. We do see a lot of short-term work still going on. So a large part of the companies, it's roughly 40%, are still on short-term work. So we see that we aren't back to normal yet, but things are improving. So they're improving slowly, but they are improving.
I mean, you mentioned the short-term work and this concept of the Kurzarbeit. Are you an advocate for it? Does that need to get extended in your view?
I think it is a good instrument to deal with short-term crisis. Now, extending it would mean we extend something that would last until March next year anyway. So I think it's too early to extend it. It's a good instrument, but there is a danger that in areas where we need structural change, where we need people to move to different jobs, we prevent that structural change. So it's really a trade-off. And the longer we go on and the longer companies are on this Kurzarbeit, on this short-term work, the more likely it is they will have to change. So it's, it can fix certain things, But I don't think we should have companies 1.5 or 2 years on the short-term work scheme.
From what you're seeing in the data, Clemens, should the ECB offer more stimulus as we go into the end of the year? And sort of what kind of measures would really help sustain, I mean, what is clearly still a very fragile, very nascent green shoots of an economic recovery? Let me put it that way.
I think we need to see that the German situation is better than the average situation in Europe. The European economy is suffering really from the difficulties with tourism, with travel. So it's a fragile situation. At the same time, I think it would be too early for the ECB to enact further stimulus. I think we should observe how the current measures work. And then see what's going on. There's a lot of stimulus in the economy. There is a lot of fiscal stimulus. I think what needs to happen now is the European recovery program. We need to get these projects going. That's more important than more monetary stimulus, in my view.
There's been a lot of back and forth in the press, Clemens, about whether or not the Schuldenbremse or basically the break on some of the debt regulations should be continued. Do you think that rule should stay suspended going into next year?
I'm afraid it has to remain suspended. There is no way in which we will return to a balanced budget in the at the federal level next year. So it will have to be suspended next year, and I'm not even sure we can get back to it in the year after that. At the same time, I think the signal is important that there is a strong commitment to fiscal solidity and consolidation in the medium term, but not now. There is no return to a balanced budget next year.
So as we look forward then, what should the priorities be for the government in terms of bringing together the right tools for a fiscal package to really sustain some of what you're talking about?
Again, a lot of fiscal stimulus has been decided. The challenge now is to make sure it really happens. So deciding fiscal stimulus programs is one thing, but really getting them to go is another. Getting public investment to be realized is a challenge because there are so many bureaucratic procedures. We have to make sure that these things really happen. There is a danger that the public investments that have, where we have the money ready now, that they happen in 2 or 3 years from now when the crisis is over. So I think at the moment it's more a question of implementation. The other thing is we need to make sure that we do not have to return to a general lockdown. We see infection numbers rising everywhere at the moment, and that is a challenge. It can be handled if we act decisively when there are local outbreaks. But what shouldn't happen is another general lockdown. We need to avoid that.
I mean, one of the tools that have been implemented is the suspension of some of the insolvency filings. That may make a lot of sense in terms of trying to fast-track some of the bureaucracy. But at the end of the day, you also run the risk of creating zombie companies, not just a few, but a lot of them. Is that something you're beginning to think about as well?
Absolutely. That's a tricky question. So I think it was right to suspend this because we don't want courts and other institutions to be overburdened with insolvencies. At the same time, there is a danger that they get overburdened once we get back to the old rules. So I think it's now time to think about new.
I'm placing a stop on profit for British pound at 130.95. Stop on profit at 130.95.
Process more efficient and quicker.
Clemens, really appreciate your insights there. That's Clemens Fuß. He's the EFO president, of course, with some additional perspective on the latest news. Now, coming up, progress. U.S.-China negotiators discuss the Phase 1 trade deal as Washington says both sides are committed to its success. We're going to break that down next. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gamenedine in Dubai. Let's get you up to speed then with the Bloomberg Business Flash headlines, starting off with the biggest reshuffle for the Dow Jones Industrial Average in 7 years. ExxonMobil, Pfizer, and Raytheon are out, and they're making way for Salesforce, Amgen, and Honeywell. The new companies will enter the gauge next week, and it's a stunning fall from grace for Exxon, especially. That's was the world's biggest company as recently as 2011. TikTok has asked a federal judge to block the White House from enacting a ban on the video app. President Donald Trump says TikTok is a security risk for user data, but the company says the president's decision was made for political reasons and is unconstitutional, violated rights as well to due process. Virgin Atlantic is set to find out if it has enough support from creditors for a £1.2 billion rescue. It's already won the backing of 3 other creditor classes and now has to convince suppliers. If they vote against the plan, the airline can take it to a judge to overrule them. That's the Bloomberg Business Flash. Let's circle back then to one of our top stories. Senior U.S. and Chinese officials have held a routine call, and they say that they're satisfied with progress under their Phase 1 trade deal. The USTR says they address steps China has taken to ensure protection for international and intellectual property rights, eliminate forced tech transfers, and remove barriers to U.S. companies in finance and agriculture. The two sides say they are committed to the success of the deal. Let's get out to Julian Chillingworth. He is the CIO at Rathbones, and he joins us now. Julian, I mean, initially then the market taking this very positively. To what extent were you surprised that they were able to make progress, not just this fast, but at such a, well, testing time, especially given that U.S. elections are just around the corner?
Good morning to you. Yes, indeed. I mean, it's positive news that they held the meeting because, as you may recall, less than 10 days ago, the meeting was postponed. So that's good news, and that they are making progress. But we should also bear in mind that, if my memory serves me correctly from some stats I saw, that as of the end of June, the Chinese had only completed 23% of the amount of U.S. goods that they said they were going to buy this year. So there's a lot of work still to be done, and I think it will be great to see some fresh orders coming through. I'm sure Donald Trump will be delighted to see some purchases of agricultural products, for instance. So let's see whether talks today then move on to actual buying of U.S. goods, and also giving U.S. companies, which was talked about today in this meeting, access into Chinese markets more openly.
There's been a very heated debate around the market breadth in the S&P 500. And, Julian, I want you to weigh in on this for me, because 59% of the S&P 500 members are trading above their 200-day moving average. And the last time we had this was in late 1999 to early 2000. It was right before the internet bubble burst. Your research underscores that there are still significant risks that remain. What is going to derail the momentum that we're seeing?
Well, I think that I don't know whether you got a simple PE chart or even a cash flow analysis chart that you could look at the tech sector, but obviously you saw massive overvaluation in the tech sector as we ran into the bursting of the TMT bubble. And I would suggest to you that we're nowhere near that now when you look at the PEs on the tech sector. Yes, they're high, but we're in a much lower rate environment, in a low growth environment as well, even if recovering from COVID-19 quite quickly in this quarter. So it's a very different environment. You've got companies making good profits, generating good cash flow, and I think they will sustain their higher ratings. What obviously will derail some of the bubble-like valuations we've got is if they don't deliver. These companies can't produce profits in the near term or next 12 to 18 months and are just rated on a function of sales or even not even sales. So it's the ones that have been inflated and dragged along by this momentum we're more worried about, not the larger companies that are producing profits.
Right.
And also I would say to you that I don't think, unless
you're very optimistic about a strong bounce in the economy, you're going to see the value names come to the fore anytime soon.
Sure. Julian, again, it's a question of trying to mitigate risks, and the rally that we are seeing in these assets is a cross-border rally for the most part, and Credit Suisse really underscores the pain that a lot of portfolio managers and sort of fund managers are having to deal with, because bonds no longer work to diversify stock risk. So how do you go about that?
Well, I think you obviously, first of all, you're absolutely right that that yields have fallen back, and there's little, shall we say, short-term mileage in the bond market as far as we're concerned. Although I would always emphasize that we say to our clients that you need elements of government securities, government bonds in your portfolio, to give some access to easy liquidity and a degree of diversity, it's not going to be the driver for gains and alpha in your portfolio. That is going to be through equities, and we continue to believe that. In terms of diversity, I mean, obviously, people have been buying gold. Now, this is all about the debate of whether you do or don't believe in gold as a diversifier, and also whether you do or don't believe that we're going to see some measure of inflation a year or so down the line, which will be helpful for gold. So, I mean, I think there are ways to diversify. The other ways, obviously, are looking at alternatives. Infrastructure has been cited as an interesting play, particularly with government stimulus. So there are other elements that you can look at within your portfolio to give some diversification.
Julian, hold that thought. We still have a lot to talk about. That's Julian Chillingworth. He is, of course, the CIO at Rathbones. Well, up next, the German economy shrank 9.7% in the second quarter. We're going to get deeper into the data from the euro area's biggest economy. That's next. And also, of course, the calls from Julian Chillingworth. This is Bloomberg. You're watching Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Well, we have some breaking lines hitting the Bloomberg from the key voice, of course, of the German cabinet, Mr. Scholz. He's speaking at a news conference in Vienna, and he's saying that there are signs that the German economy is developing better than expected. It comes after the back of news and data that we got that German companies and consumers cut spending sharply during the virus-related restrictions. The German economy contracted 9.7% in the second quarter. Initial estimates for 10.1%, that's what they had been penciled in for. The numbers, of course, show the scale of the slump at the height of the lockdown restrictions in the euro area's biggest economy. Let's get back out to Julian Chillingworth from Rathbone. Julian, your initial reaction then on these figures?
I think it's good to see a slight improvement on the first estimate that we saw, but not a surprising number at 9.7. And I think, it's all about how quickly the German economy bounces back in Q3. The flash PMI numbers we had on Friday, I think, were slightly disappointing for the euro area more generally, and there may be concerns that the bounce back in Q3 won't be quite as strong as some people had been estimating. So we'll just have to see how that fares, and obviously with a pickup in the new virus cases across Europe, and concerns about localized lockdowns, that's obviously going to hit growth across the region more generally. But in Germany, I think they're doing all the right things. Angela Merkel's handled the COVID-19 crisis well to date, and I would hope to see a reasonable bounce back in Q3. But obviously, we need to wait till the end of the quarter to see how that pans out.
So where's the opportunity then in Europe at the moment? If it's not going to be so much Germany, because in your research you highlight that sterling's already pricing in a lot of very negative scenarios, and at the same time UK stocks are trading quite a notable discount compared to some of their global peers.
Yeah, they are, and I mean it's also partly due to the makeup of the UK market. Obviously, a heavy energy component along with materials has an effect, and obviously quite a heavy domestic consumer weighting as well. But I think where the UK is concerned, obviously it's all about now how quickly we see the UK economy recover. The leisure sector is making some positive signs. Help out, Eat Out to Help Out has been positive, and I think we could see perhaps a surprising Q3 in the bounce in the UK economy.
Julian, thank you very much. A little bit squeezed for time there. That's Julian Chillingworth, the CIO at Rathbone. We're going to get into the U.S. elections next. This is Bloomberg.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Let's get to the Bloomberg First Word News again. Here are the stories we're watching. The U.S. Food and Drug Administration is walking back its claims over an unbrought and experimental plasma therapy. On Sunday, the agency's commissioner said it provided dramatic benefits and could save a huge number of lives. But last night, the FDA was forced to clarify its numbers. There are promising signs for the treatment, but the benefits aren't yet fully known. Wisconsin's governor has deployed the National Guard after police shot a black man in the city of Kenosha, south of Milwaukee, on Sunday. Troops are being tasked with guarding infrastructure and protecting firefighters. But the ACLU has criticized the move, calling it militarized policing. After hitting the Caribbean, Tropical Storm Laura is poised to become a powerful hurricane. It's due to make landfall on the U.S. Gulf Coast on Thursday. An alert has been issued already in parts of Texas and Louisiana. Another storm, Marco, has lost so much of its power, it's weakened to a tropical depression. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. That's the News Belt update. Let's get then to the story around the Republican Party in more detail, because they formally nominated President Donald Trump for a second term. Trump has sought to paint a positive picture of his handling of the coronavirus pandemic. More broadly, a procession of speakers, including members of his own family, have set out to counter the Democrats' portrayal of Trump as incompetent and to depict his opponents as radicals.
These are the incredible workers that helped us so much with the COVID. We can call it many different things, from China virus. I don't want to go through all the names because some people may get insulted, but that's the way it is.
Biden's radical left-wing policies would stop our economic recovery cold. He's already talking about shutting the country down again. It's madness.
The economy is on the ballot. Law and order is on the ballot. Our most cherished ideals of freedom and free markets are on the ballot.
So when it comes to what Joe Biden says he'll do, look at his actions. Look at his policies. Look at what he already did and what he didn't do.
The intelligence community recently assessed that the Chinese Communist Party favors Biden. They know he'll weaken us both economically and on a world stage.
Joe Biden and the Democrats are still blaming America first. Donald Trump has always put America first, and he has earned 4 more years as president.
Joining us on the phone is Bloomberg's Kathleen Hunter now for the latest. So what exactly is the Republican strategy here ahead of the election? What's crystallized?
Well, I think that what we're seeing here from the Republicans is kind of the counterpoint to what we saw from the Democrats last week, painting a very scary and negative picture of what the country is going to look like after 4 years of Joe Biden. Last week, what we heard from the Democrats was a similarly negative picture of what the country would look like after 4 more years under President Trump. And so I think that in some ways that's not surprising, but it seems like in some ways, the Republicans are trying to make this a referendum on Joe Biden's vision for America. And generally, that's not how these elections work. Generally, these elections are referendums on the sitting president. And so I think it's a harder sell for the Republicans to sort of paint this scary picture of what the country is going to look like with Biden as president, given what's happening now with the economy and the coronavirus. but that's certainly going to be their strategy, I think, going forward.
What do we know exactly about the content of the call on the phase one deal, and how significant is that really in the broader portfolio?
Well, I think so. There was this call about, phase one of the China trade deal, and I think that it sounds like all signs coming out of that were pretty positive in terms of both sides, the U.S. and China, wanting to continue to make progress towards a trade deal and really more significantly being committed to the deal that was already made. And so I think that is certainly significant. I would expect Trump and his allies to continue to talk about that type of progress with China. But of course, this all has to happen within the context of, the broader deteriorating U.S.-China relationship and the fact that, Trump is at this time, it's a bit of a difficult needle for him to thread, given that he's trying to, on one hand, tout the progress he's made with China, but on the other hand, paint China as a villain. We heard it in one of the clips you just played. He's calling it the China virus. He's talking about, there's increasing signs from everything from TikTok and WeChat to, the relationship with Hong Kong. The U.S.-China relationship is really deteriorating. And I think that, pointing to this sort of small-scale, small-bore trade deal may not really counteract that all that much.
Kathleen, thank you very much. Great catching up. That's Bloomberg's Kathleen Hunter there. Let's get some more context on what the election means for emerging markets. Joining us now is Luis Costa. He's the head of CEMEA FX strategy at Citigroup Global Markets. I mean, Luis, for emerging markets, a lot of this is going to come down to the valuation of the dollar, isn't it? And, given that we already have local outflows at the time of a weaker greenback, it's not necessarily going to be straightforward sailing, is it?
That's right. And to be honest with you, the markets have already absorbed a lot of this dollar bearishness, and they were right. The one derivative in terms of broad dollar dynamics from central banks boost in the balance sheet is the case of the Fed, is the case of the other DM central banks, is dollar weakness. And that's exactly what we are having now. So, I mean, there are other derivatives as well. For example, the bids to gold. I mean, it's not about risk aversion. It's about, a big boost in central bank liquidity and what does it do to precious metals. So this is all part of the cycle here. So the dollar is definitely giving a very nice gift to some EM currencies out there, even though we remain quite skeptical of, massive performance on the MFX side.
There's a lot of debt that's being issued in emerging markets, in developed markets. Ultimately, that's going to start weighing on U.S. 10-year yields. And it's a very, very heated debate. So I'm not going to weigh in on that on a personal note. But from the people that we've spoken to, there is upside risk here. Is that the next front that you'd be watching?
That's exactly our point. Upside risk, I mean, in terms of yields, right? I mean, we, especially on the EM European side, on the CEMEA side, we've been very worried in a way of the implications of the vaccine trade. I mean, we are in a moment where term structures in many parts of the EM world, in the EM world as well, they are so flat and they're so low. And here we are, in an environment where 4 or 5 possible vaccine solutions to come afloat over the next, couple of quarters. So I believe this is present and immediate danger to term structures out there. So we don't want to be received rates in many low yielding curves in EM now. We actually believe this is a time for steepeners and payers in some of these curves.
Luis, I was looking at the world currency ranker on the Bloomberg, and year-to-date total return on some of these emerging market currencies might be a few surprises here for some of our clients. And we put this up on a graphic. The Egyptian pound and the Argentine peso leading those gains with sort of double digits. I mean, about 10% for the Egyptian pound. You remain positive on the Egyptian pound. Is that on the local currency duration play? Is that how you would go about this?
Yeah, that's exactly it. I think that Egypt still has a very interesting development story in terms of trying to reshuffle the fiscal side despite the COVID crisis, of course, and the fact that monetary policy has been very transparent in a way even better than some of the major EMs out there. in an environment where we don't feel a shock, an imminent shock on the inflation side. So the development in terms of flow has been a positive development in terms of clients getting more exposure to the fixed income, the local fixed income side, which is obviously positive for the currency. So we do like, we are very skeptical in terms of frontier in general now, but we do like Egypt if compared to other major plays in EM liquids.
Let's circle back to the positive news around hopes of a vaccine breakthrough and some progress in these trade negotiations between the U.S. and China. Is the primary beneficiary going to be within the EMFX space, the Asia complex? Is that what we need to be watching out for?
Well, I think that's, our positive view on EM Asia goes through various channels, right? It's the fact that if you look into China, and there was one host talking about China maybe 10 minutes ago with you, and China, if you look into the macro barometer of China now, it's screaming for renminbi appreciation. And that's exactly what we're seeing now. In an environment where, I alluded to my previous comments, in an environment of relatively weak dollar dynamics or broad dollar dynamics. We are seeing, there's a fiscal impulse coming out of China. You're seeing some better developers on residential and building, the building sector. So this is all coming to grips here, and it probably tells you that renminbi, there will be further renminbi appreciation. And this is very important for the EM FX Asia complex. It helps a lot the low yielders over there as well, the Koreas of the world, the Taiwans of the world. So we believe that, dollar Asia now, or Asia FX, is in a much better zip code if compared to LATAM and CEMEA.
We saw what happened in Turkey. The idiosyncratic risks are very real, but in many ways, if you look at the broader emerging market space, you could make the argument that they're not being priced in sufficiently. If you had to pick one country that fits that description, which one would it be?
It's a difficult one. We to be honest with you, we've been switching gears quite a lot to the credit worthiness of South Africa. And I do believe, even though we are invested in South Africa in other parts of the curve, we do believe that the credit worthiness side is very important. One of the big derivatives of this COVID crisis is a big boost in the fiscal worries, right? And South Africa was already struggling quite a lot on the fiscal side, and this is now only augmenting fears and concerns of fiscal imbalance going forward. So we've been very focused on the credit worthiness side of South Africa if compared to other EM majors.
Louis, I've really enjoyed this chat. A lot of insights there. Thank you for that. That's Louis Costa. He's the head of CEMEA FX strategy at Citigroup Global Markets. Coming up, has the Fed created the speculative bubble? Well, Omega Family Office Chairman and CEO Leon Cooperman thinks so. We have more from that conversation next. Worth staying around for. This is Bloomberg. Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gamenedine in Dubai. Well, let's take a look at some of today's key events that we've marked out on the agenda. Chinese Foreign Minister Wang Yi starts a tour across Europe. He will be visiting Italy and then the Netherlands, Norway, France, and then on top of all of that, it's going to be Germany as well. The trip comes ahead of a key summit between President Xi and some EU leaders in mid-September. Richard Branson's Virgin Atlantic, in the meantime, told a London court that it will run out of cash in September unless it secures a $1.6 billion rescue package. And today, the airline is going to be convening creditor meetings to vote on the restructuring. And then this afternoon, watch out for U.S. data at 3 p.m. UK time when we will get the figures for new home sales for July. And then you also have the consumer confidence for August. Well, while the Fed's response to the pandemic helped stabilize the markets, low interest rates are creating a speculative bubble. There's no argument around that. That's according to Leon Cooperman. The Omega Family Office chairman and CEO spoke with Bloomberg about how exactly zero rates and mounting national debt are impacting the U.S. economy. Take a listen.
They have created a real speculative bubble, in my opinion. I have to admit that I'm uncomfortable at the present time not because of the virus. It's a factor. I'm uncomfortable because I'm focused on something the market isn't focused on, and that is the amount of debt that's being created. Who pays for the party when the party is over? You know, we just celebrated our 244th birthday, and basically it took us 244 years to go from zero national debt to 21 trillion. We'll probably end this year at 27 trillion. That is a growth rate in debt far in excess of what the economy is growing at. And I think that that's going to be a problem down the road.
Yeah, well, back in...
And I think they've created a real speculative environment. You know, I was just looking, to give you some statistics. Apple announced their 4-for-1 split on July 30th. The 20-day average call volume at that time was 721,000 calls. Okay, this past Friday, Apple traded 2.1 million calls, 3 times the average of 20 days. Okay, and the stock is up 17% since the announcement of the split, and that's before this morning. Tesla announced their 5-for-1 split August 11th. Same thing, big increase in call volume. The stock is up 49% since the stock split was announced, against the S&P up 1.9%. Now, the last time I checked, if somebody gave me 5 singles for a $5 bill, it didn't create any wealth.
Right,
Okay?
well,
It did not create any wealth.
that was the old calculation. Now this is the new calculation when you've got a big component of Robinhood investors. That's sort of one theory out there. What's riskier right now, the high-flying stocks or bonds?
Well, I think no question that bonds, to me, present a return-free risk. And that's what's working in favor of the stock market. What I've not fully appreciated is what a zero interest rate environment does for stocks. I was focused on the fact that we've had zero interest rates in Japan and Europe, and their stocks are 5 or 6 multiple points below the United States market. So I think low interest rates are indicative of a problem economy. You know, we've had artificial support for the economy since 2008. You know, it's 13 years. And I don't look at that as being a positive. I look at that as possibly being a negative. You're Stephen Ratner, close to Mike Bloomberg, who I have enormous respect for, basically wrote an article this morning in the Times op-ed piece, the economic recovery that isn't. You know, I think that the zero interest rates is creating a very speculative tone to the market. I have said for months now that we're really dealing with 3 markets, not one market. The first market is the FANG market. And frankly, these are very fine companies, these technology companies whose demand has been pulled forward by at least 5 years due to the virus. They're not cheap, but by the historical standards of the Nifty 50 of 1972 and the technology bubble of 2000, they're not in any way expensive. And people could conjure up whatever they want to conjure up.
Into the world of Stephen Ratner, you...
Position closed on British pound at 130.95.
Cooperman theory, given the distortions that we have now, can you stay with original investment science, or do you have to invent something new for the next 10 years?
Look, I'm 77 years of age. I have no clients. I retired at the end of 2018. and I do what makes me comfortable. Right now, I have very, very, very few bonds. I think bonds represent a return-free risk. And I own, I was beginning to explain to you, there's three markets out there. There's the FANG market, richly appraised, but not ridiculously appraised, okay?
Yeah.
Then the Robinhood market, which is ridiculous, totally ridiculous. Regrettably, I said this on TV about a month ago, that market would end in tears, and the very next day, some young man who lost $70,000 day trading committed suicide. Okay, Carl Icahn is as bright as they come. He liquidates his position, Hertz, at 72 cents a share, and 3 weeks later is trading at $5. And you check into what's going on, it's on the Robinhood platform. Eastman Kodak, Robinhood platform. Tesla, Robinhood platform. So, that's going to end in tears. I have no interest in that market. It's not rational to me. I don't spend time on it. The third market, there's things to be done, and that's everything else.
Fascinating conversation there with Leon Cooperman, of course, the Omega Family Office Chairman and CEO. I want to get back to the market action because, wow, what a lift up we're seeing in some of these equity markets, especially so in Europe and in the United States as well. Overnight record highs, and we're looking to extend that on the S&P 500, currently called higher by 0.2%. Even though Morgan Stanley is beginning to get a bit skeptical, they're saying the S&P 500 is top heavy and looks primed for a correction. U.S. 10-year yields currently at 67 basis points, pretty much unchanged. Euro dollar 118.15. I mean, again, this is a dollar weakness story. We're currently up 0.25% there. And then gold, after initially getting a bit of a push upwards, now retracing that, we're down 0.1%. Coming up, the year of the day trader. We take a look at the surge in retail investment around the world next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Is 2020 the year of the day trader? Bloomberg Intelligence now estimates that retail investors are the second largest segment in U.S. trading markets, with a 200% surge in trading volume. That's year on year. Simone Foxman joins us now from Doha. Simone, this isn't just a U.S. story. I mean, let's be realistic about this. How substantial is this surge of retail enthusiasm globally?
Yes, certainly extends beyond the United States. And if you want an exemplar of this, look no further than China. 2.4 million new brokerage accounts in July alone. That's the fastest pace since the stock bubble back in 2015. And that's part of a 6.5% surge in the overall number of brokerage accounts in China this year. But those numbers I could give you for so many countries. Yusuf, we could talk about India. We could talk about the UK, where AJ Bell and Hargreaves both say they're taking on lots of new accounts. We could also look at the US, where even not just Robinhood, but the old traditional old guard saying they're getting lots of new accounts. This has contributed to the dramatic surge we have seen in volumes, particularly in Asia, just indicative of how much of an impact this changing composition of the retail market having on the markets overall.
And what do we know about where retail money is going, Simone?
Well, Yusuf, Bloomberg Intelligence has done a study of where the highest traded retail stocks in the U.S. and the U.K., particularly for those Robinhood-style investors. And they note three things. These investors like low profitability, they like high volatility, and they like cheap stocks. So that low profitability stuff, that's really seen in some of those airline plays, Boeing, high volatility, love for Tesla, and that cheap stuff, that's what's coming through in some of those micro cap indices, those small cap indices in Asia. Those are particularly outshooting the country benchmark there.
Simone, some very interesting angles here to the global story. Simone Foxman, a reporter in Doha. Well, we have, of course, a situation in global markets where it is firmly risk on, as there are signals that the U.S.-China trade tensions are turning more into a little bit of reconciliation. Progress has been made, is what we're hearing from both sides, and that's getting reflected in terms of upside in Europe and beyond. Plenty more ahead. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
This morning, 100 years ago, American beet sugar. It was dropped from the Dow. In 2020, it is Exxon that has shown the Dow door. The new Dow is digital dominance, Amgen, Honeywell returns, and Salesforce.com. Equity surge higher this morning. It will be a virtual Jackson Hole. Chairman Powell, he will speak. He will rationalize a growing negative real yield. And it was not that, freshman year in college, Western Civ course, the one you slept through. Republicans line up for, quote, the bodyguard of Western civilization. Good morning, everyone. This is Bloomberg Surveillance in New York. Tom Keene, Anna Edwards in for Francine Lacroix in London. Anna, we have slipped into August. We've got the entertainment of the Democrat and Republican conventions in America. What's going on in England?
What's going on in England? Well, it's quiet politically. That's what happens in the summer. People disappear from Westminster, and it is quiet. I know that you've been reading about the proms, and that's something that's sort of on the social scene, I suppose, here, and the controversy over which songs should end the proms. This is a musical event that happens at the Royal Albert Hall every year, of course, much scaled back. So I'm slightly preoccupied by the latest comings and goings on that front.
We've got economic data on Thursday. Jobless claims are so. What is the trend of the economy that you see? Right now in America, it seems to be almost a two-part economy, very, very separate.
Yeah, indeed, two parts. We was talking this morning actually about the K-shaped recovery. I know our colleague John Authors put out a great piece this morning talking about how tech stocks, growth stocks do well, value stocks, other stocks, left behind sectors not doing quite so well, even if you look at the US right now. So that's something we'll get into during the program. But trade also really dominating in the news overnight.
Yeah, K-shaped recovery. Kit Jukes writing on that at SocGen this morning. But lots to talk about here. A busy Tuesday in an unusual August. For a briefing with our First Word News, here's Ritika Gupta.
And President Trump and speakers at the Republican National Convention put a positive spin on his handling of the coronavirus pandemic. The president thanked frontline responders and said the virus is going to be fading. And others warned what would happen if Joe Biden is elected.
But there is a light at the end of the tunnel. Job gains are outpacing what the so-called experts expected. But Biden's radical left-wing policies would stop our economic recovery cold. He's already talking about shutting the country down again. It's madness.
More broadly, a procession of speakers set out to counter the Democrats' portrayal of the president as incompetent. U.S. and Chinese negotiators have discussed the Phase 1 trade deal, and the Trump administration says both sides see progress and are committed to its success. Trade is one of the rare areas of cooperation between the world's largest economies. Still, China is far behind its promises to increase purchases of American farm energy and manufactured goods. In Germany, Chancellor Angela Merkel is demanding full transparency from Vladimir Putin's government over Russian opposition politician Alexei Navalny. A German medical team determined that Navalny was likely poisoned last week. Merkel called for a full investigation. The Kremlin hasn't responded. And ExxonMobil is out at the biggest reshuffling of the Dow Jones Industrial Average in 7 years. Pfizer and Raytheon have also been booted in a signal that tech companies have gained even more dominance. The new members of the Dow are Salesforce, Amgen, and Honeywell. The actions were prompted when Apple announced a stock split that reduced the sway of computer and software companies in the price-weighted average. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Anna, Tom.
Ritika, thanks so much. Really glad you ended with that Dow switch. That's a huge deal, folks. The symbolism of this, for those of you a global audience, I really can't say enough of the symbolism of what occurred yesterday with the Dow Jones Industrial Average. Sarah Ponczak and Catherine Greifeld wrote a terrific article for Bloomberg. I put it out last night. I'll put it out again this morning, giving you some of the historical backdrop to what they've done to the Dow. Salesforce.com, speaking of data, up 21% per year in the last 10 years. Equity surge on the news and, of course, on the stock splits as well. Maybe some trade glory in there as well. Futures up 11, Dow futures up 131. The VIX really hasn't moved. That's an important sign, 22.44. I need to go way over to Turkish lira. 7.40 rounded up. Mr. Erdogan talking about the economy today. He is not happy as what's going on in the foreign exchange market. And Anna, the 10-year real yield, the tip, negative 1.01 to round it down. That will be front and center for Chairman Powell. Anna?
Yeah, absolutely. Jackson Hole coming up on Thursday, of course, and we looked at his comments around that real yield and around average inflation targeting. On my data board, Tom, I've got a host of reactions, really, to US-China policy. So it's a sort of European-focused data board, but it does react to the big global themes between the US and China. The fact we've seen this more positive mood music between the two overnight, that's lifted stocks here in Europe. It certainly lifted the DAX. And the DAX, just to make this point, year-to-date now only down by 0.9%, which is one of the best-performing markets in Europe, certainly of the big ones. Other markets in Europe far, far behind. So we'll talk about Germany in just a moment. I also put in the euro and the pound, both of those benefiting as the dollar retreats, given that news around trade. Now, German companies have turned slightly more optimistic than Tom that the economy will continue on its long road to recovery, but job worries linger. Chancellor Angela Merkel's cabinet is set to discuss an extension of its generous state wage support program today. Joining us now is Holger Schmieding, Berenberg chief economist. Great voice to have on the program then this morning. Holger, welcome to Surveillance. Let me start by asking you what's going on in Germany. We've had confirmation of the dire but relatively good, I suppose you could say, GDP picture. German businesses' confidence there seems to be picking up just a touch, and we look for progress around job support schemes. How likely is it, do you think, that the government will add to the job support scheme, the furlough scheme, allow it to run longer?
That is very, very likely. Simply, we have an election next autumn, and none of the major party wants to be seen as being too restrictive on these measures that actually help people who are waiting for their job, for their work to come back. The scheme is working well. It will be extended. It will probably be modified. The economic data do tell us that Germany is recovering from the drop in GDP in the second quarter, which was about as bad as the drop that we had seen in the US.
Yeah, so the furlough scheme, just to make this point for international viewers, it covers typically, or at least at the start, around 67% of the net wages of German employees. What are the latest signs around the German economy and how it's recovering? Because European PMIs were certainly pointing to a bit of a slowdown in the path to recovery, Holger.
Well, the PMI data are extremely volatile and difficult to interpret. They had been extremely high in July and thus suffered a significant, unexpectedly pronounced setback in August. I would look more closely at these surveys, such as the German IFO survey, which has a longer history, is well established in the country, and which does suggest that indeed the recovery is flattening out a little. More precisely, the pace of the rebound is becoming less steep, but the rebound is continuing, and that's in line with what we call the tick shape recovery, which is it starts not quite but almost like a V as supply is being switched on, which was the case from May, June through July, and it is now getting flatter with, in parts of the economy, the new virus concerns adding a bit to the flattening profile.
Holger, I want to draw everybody's attention to the importance of Chairman Powell's speech here at Jackson Hole. Folks, usually it's a different speech than what we get from central bank leaders. I believe Mr. Bailey to attend as well in this virtual conference. Holger Schmieding, are you looking at the real yield, inflation, the yield minus inflation to the real yield, or are you looking much more at the nominal yield and inflation expectations?
I, of course, look much more actually at the nominal yield and to some extent at inflation expectations. Inflation expectations matter quite a lot for central banks, and the key question to ask is how long will rates stay as low as they are? And the answer is probably with inflation expectations remaining comfortable in the territory that central banks would like, or being actually below that, rates, central bank policy rates, can stay low for longer, which is no surprise, but that's what we look at.
What is the price of that? I mean, you have been one of the best people I know on the chronic nature of negative interest rates in Germany. What is the price to a banking system? What is the price to society, indeed, of chronic negative rates or a chronic negative real yield?
Well, Germany is a very good example for all these things indeed. We have real yields negative more often than other countries simply because our benchmark bond, the Bund, is seen as a safe haven in Europe and beyond, and hence with extra demand for German paper over, say, French or Spanish paper, our yields are lower. That, of course, means for those savers, especially in Germany, who value the certainty of investing in bonds, they do pay a price for it. It should be a reason to buy equities, including German equities, and the DAX isn't doing too badly. But one price, of course, is that if interest rates and yields are low for long, it is a problem for the banking system. As an economist, I must say what I really look at in the banking system is, does this chronic problem for the banking system, which we have over here, impair credit creation? And this is not the case. So in a way, it's a sector problem for financial institutions, but it's not a macroeconomic problem in the sense that the weak banking system, in many respects, a weak banking system, is actually hurting the overall economy.
Holger, what would it take to take Germany out of negative rates, out of looking at the 10-year Bund yield, for example, at a negative 0.46 right now? What would it take to get us back to positive territory? It was only 2019 that we were there, but what would it take? Is it to do with the virus and a vaccine?
Well, that would probably be a significant contribution. As you said, what we would need is a return to the conditions of roughly 2019, when we did have, or 2018, when we did have an economy that was doing fairly well across Europe until the trade war and then the virus struck. So we would have to have an established upswing that probably surpasses, in terms of the level of GDP, what we had before the pandemic. So I would say let's wait for about 2 years until we may get there.
Holger, thanks so much. Holger Schmieding of Berenberg. Stay with us. Thanks very much for joining us. More with Holger in just a moment. Later this week, follow Bloomberg for our coverage of the Jackson Hole Economic Symposium. We'll be talking about it all week, of course. It takes place, though, starting on Thursday and then into the weekend. They won't physically be there, or not many of them, but of course we will be there, even if this event is taking place remotely. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get your Bloomberg Business Flash. Aviva Group has agreed to buy industrial software maker Osisoft in a deal valued at $5 billion. About $4.4 billion of the deal will be paid in cash. The British firm will fund it in part with a $3.5 billion rights issue. Osisoft is based in California and is backed by SoftBank's Vision Fund. Apple has won an early court victory in a fight with Epic Games, the maker of Fortnite. A judge spared Apple from having to immediately reinstate the video game on its App Store, but she also blocked Apple from limiting Epic's ability to provide key graphics for other apps. The fight has to do with the tolls Apple charges app makers. And Citigroup is chalking up its wayward $900 million payment to one thing: human error. The bank mistakenly transmitted payments to lenders of the cosmetic giant Revlon after an employee didn't manually select the correct system options in loan software. Some lenders are balking at returning the payments. They say Revlon was in default and owed them the money. And that's your Bloomberg Business Flash. Tom Anna?
Ritika, thanks so much. This is Jack Ma, and this is really interesting, folks. It's not just another big IPO and, the bragging rights and all that. The symbolism here is extraordinary. Owned 1/3, I believe it is, by Alibaba, and ANT will come public, and they've announced the IPO. It's not in New York. Maybe the president will comment on that at the convention. But far more, it is a dual listing in Hong Kong and Shanghai. Anna Edwards, I look at this announcement, and obviously the bragging rights of being larger than Aramco is all part of it. But for those of us in America, the listing not in Shanghai, which I believe is all Chinese, but in Hong Kong, the winners of this looks like it could be Citigroup, JP Morgan, and Morgan Stanley. There's a few names missing from there.
Yeah, for what it's worth, the bragging rights, they might get the bragging rights. We can dismiss them, but it could be a very big IPO, couldn't it? Mega is the word being attached to it by some of our colleagues this morning. Tom, it could be the biggest debut in years. It could top Saudi Aramco's $29 billion IPO. And this really is the crown jewel in the Alibaba empire, our colleagues are telling us this morning. Ant has been accelerating its evolution into an online mall. Sells everything, Tom, from loans to travel services. Not so many travel services, perhaps, these days, but plenty of loans.
Yeah, well, we say good morning to Dr. Roach. Of course, this was Morgan Stanley years ago in his path-breaking work in China. Somehow, you have to believe Steve Roach had a little bit to do with Morgan Stanley landing that relationship over the long term. We'll have much more on this through the day. Right now, Holger Schmieding, patient with us at Berenberg, and their chief economist. Holger, I want to go back to the idea of a two-part economy. What I observe in New York, what I observe across this nation is inequality due to the pandemic that we've never seen. I'm sure it's the same story in Europe as well. What is the policy prescription to begin to get this inequality improved by helping the poor? How does America do that? How does Europe do that?
Well, it's a pretty patchy effort, I would say, so far. In America, the data are very interesting, as many people actually receive more government support than they did earn when they had a job. But this is, of course, a one-off special factor that will likely lose force over time. We see in Europe that, of course, there are signs of further inequality. They're not as pronounced as they are in the US because we have more established ways of running welfare states, of providing support to people, which are less patchy and less prone to such weird exaggerations as we see in part of the US. Going forward, what we do need is a combination of two things. The one is to keep the furlough schemes going at reasonable rates of support for as long as there is a significant pandemic effect on some heavily affected sectors. That is, for companies where you think they will actually recover once it's over with the virus, keep the support on, and then we will need a lot of government support more than before for the retraining of people to go towards the modern parts of the economy as the pandemic is accelerating structural change towards digital, for instance.
If we assume the GDP gets back to a lower level, how far below February will the run rate be of GDP? 10% below, 15% below what we knew before the pandemic?
Well, we should, by early next year, be, say, 5% below that, roughly that. And we do expect that in the US, we will, in early 2022, be back at the pre-pandemic run rate, and in much of continental Europe except Italy, by mid of 2022 we should be back to where we were, which of course means that we would still not have the labor market as healthy as it was before, as some people will have lost their job and will not get that job back. So we do need this combination of mobility support, income support, and of course especially retraining support to make what is now an accelerated switch towards a more digital economy.
Holger, from a UK perspective, would you like to see the government extend the furlough scheme? I don't hear any plans to do so. It's supposed to end at the end of October, unlike the German one, which looks as if it'll be extended.
I think the furlough scheme should be extended. There should be a careful look at whether it's calibrated in the right way, but it basically should be extended, yes.
Holger Schmieding, thank you so much. Greatly appreciate it with Berenberg Bank this morning, particularly there getting us ready for Jerome Powell and an important speech, I believe, scheduled for Thursday as well. Coming up on Bloomberg Radio here with futures up 13, Dow futures up 151. Bruce Kasman of JP Morgan, an important conversation. He had a phenomenal note out this weekend on the timelines of inflation. Should we look short term? Should we look medium term? Should we look long term? Bruce Kasman with us at about 9 o'clock this morning. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning, everyone. Bloomberg surveillance from London, from New York. Day one, day two, day three of an equity surge. There's no question about it. It is very much tech dominance. You see that with the Dow reconfiguration. Futures again up 13. Dow futures up 152. Dow level 28,391. And the VIX really hasn't moved. Interesting. This should be a 21, even a 20 handle VIX, and we're not there yet. 22.36. Anna?
Yeah, we're certainly focused on that Dow reshuffle story, the rise of tech and out with the old economy. We'll certainly dig into that later on in the programme, Tom. In terms of the data I've got for you here, European equity markets on the front foot, up by 0.4%, but they're off their highs of the session. We were up by more than 1% on some of these markets earlier on today. Now the CAC and the DAX up by around 0.6–0.7%. US futures do point to the upside, but perhaps losing a little bit of momentum there as well. We thought perhaps the DAX would retake positive territory for the year today. Maybe we have to wait another day for that. Generally then, we are risk on today, and as a result the dollar is down. The dollar index down 0.3% or so, and the euro and the pound really flying, but really it is a dollar story. So the euro up 0.4% against the US dollar, the pound up 0.4% as we look for any clues on Brexit as we head into the autumn, into the fall. Can any kind of deal be done in terms of trade across the English Channel? We'll talk politics next. James Lucier, Capital Alpha Partners senior political analyst, will get his thoughts on the Republican National Convention. Started last night. We'll get his analysis. This is Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
These
These are the incredible workers that helped us so much with the COVID. We can call it many different things, from China virus. I don't want to go through all the names because some people may get insulted, but that's the way it is.
Biden's radical left-wing policies would stop our economic recovery cold. He's already talking about shutting the country down again. It's madness.
The economy is on the ballot. Law and order is on the ballot. Our most cherished ideals of freedom and free markets are on the ballot.
So when it comes to what Joe Biden says he'll do, look at his actions. Look at his policies. Look at what he already did and what he didn't do.
The intelligence community recently assessed that the Chinese Communist Party favors Biden. They know he'll weaken us both economically and on a world stage.
Joe Biden and the Democrats are still blaming America first. Donald Trump has always put America first, and he has earned 4 more years as president.
Night one of the Republican Party, there we saw it with the Republican National Convention as well. Of course, on to Thursday, where Mrs. Kushner will introduce her father for his important speech there. Of course, the contrast here between Trump and Biden. We have a most interesting guest now to give perspective. Jim Lucier was a sell-side analyst years ago, and I mean years ago, and on the high ground on utility and oil and gas analysis. He then became part of the #1 team in Washington at Prudential on Washington analysis. Trust me, you read Prudential every day, every week, just to keep up. He's now at Capital Alpha Partners, expert on policy. We'll have a different conversation here with James Lucier. Jim, wonderful to have you on the show. I really got to go political here, and I want you to fold your policy analysis into those key swing states where the electoral votes really matter. Which policy matters to the Democrats, the Republicans, the disaffected of those key swing states?
Well, obviously, the key thing is going to be take-home income for many of those states, recovery from COVID as quickly as possible. And so it's a question of who's got the best policy mix and who can go back to the pre-COVID economy. What Trump tried to do last night was to go to those voters who seemed pretty solidly behind him until May or June and say, look, I'm the guy that can bring back the pre-COVID economy.
How can he do that without a stimulus bill? What is the urgency for Vice President Biden or President Trump to get a stimulus bill done? We've seen the impact just in the last number of weeks here in New York City. I can't imagine what it's like as well nationwide.
Well, they're relying on a fundamentally strong economy prior to COVID. They're hoping that the tailwinds from that will ultimately support them. Larry Kudlow talks about a V-shaped recovery all the time, if you believe that. I think the alternative case from Biden would be that you do need a major stimulus package that would be paired with a corporate tax increase that would partly offset it. But it's two different visions. You know, should the private sector lead or should the government lead?
Good morning to you, Jim. So it's clear that the coronavirus, COVID-19, has played havoc with the U.S. economy. But has it played havoc with Republican voters' assessment of the Trump economy? Do Republican voters think that he's done a good or a bad job on the economy? Because I was looking at some polling. YouGov polling said 7 out of 10 Republican voters actually still approve of Trump on the economy. His ratings with certain groups are quite resilient, aren't they?
That's actually the case. George W. Bush, by this point in his presidency, had already lost a lot of his core supporters. Trump maintains much of his base, and believe it or not, he has surprisingly good ratings on the economy from people who otherwise don't like his personal style, from people who otherwise disapprove of his character, and so on. So what Trump has to do in this convention, and which he started to do last night, is to make the case that really I'm the guy that can deliver the economic performance that you've already seen, whereas Biden is an unknown quantity.
Parties always tell you they're all about the winning and the going out to win, no matter which democratic system you're operating in, Jim. Would it be different? Would the policy that the Republicans adopt, would it be different depending on if they really are still out to win this, or if they're focusing maybe on maintaining hold of the Senate, trying to limit damage there. Which
Look,
strategy should they be adopting at this point?
The key thing for the Republicans right now is holding on to the Senate. This election is very much a struggle for control of the Senate. So part of the message last night was less about policy than reaching out to groups. Trump was going out to people that had supported him earlier. He was actually trying to find more Trump voters than it turned out in 2016, the so-called low preponderance voters who would come out. He was trying to reassure the people who supported him prior to the COVID outbreak in March and to recapture people who supported him as late as May or June. So a big part of the message last night was reassuring Republicans and suburban Republican voters in particular who like to see a racially inclusive party that you do have a party that is inclusive despite what you might hear from the Democrats or from the media. And that's why Herschel Walker was so important. That's why Vernon Jones was so important. That's why Tim Scott was so important at the end. You know, all of this is about shoring up suburban Republican voters, shoring up the Republican base, and keeping Trump in the game so he has a shot at winning, but more importantly, they hold on to the Senate majority, which is the key thing for the Republicans in this cycle.
Okay, Jim, the counterfactual then, or the opposite, is to look at Joe Biden's economic plan. Has he stated yet how he will support the economy and garner that economic confidence that Mr. Trump seems to have?
Well, he talks about good union jobs all the time, but if you look at his tax plan, it's scored by the Brookings Institution to raise $2.1 trillion over the next 10 years. The CBO baseline over the next 10 years is $3.1 trillion, so $3.6 trillion. So do the math. 2.1 trillion over 3.6 trillion is a 58% tax increase. So he's really got to come out and explain that his green stimulus program, where you have government demand, driving demand for electric vehicles, photovoltaics, advanced grid equipment, all of that stuff is the key thing that will drive both jobs and the economy.
Jim, this is your wheelhouse. This is what you do best. What is your advice to Vice President Biden to connect the dots, or as you say, do the math?
I think Biden needs to come out and really start making the case more forcefully. Perhaps that's the case for Kamala Harris now. The vice president is traditionally the more aggressive partner in a ticket. And, she needs to come out and, take the case to Trump and take the case to the American people that we don't need to revert to the past. We really do need a bold vision for the future. And I think that as long as Biden stays in Delaware for whatever reasons, it's going to be harder to present that image of a dynamic future. So it could be that we just have a planned and natural handoff to Kamala here. But I do think the Biden campaign needs to step up and present its vision for the future, which in fact I think they're doing well already, but they need to put on the gas right now.
Is there a risk there, Jim, though, if they do that, if they come out policy heavy, is there a risk that they lose those voters who maybe, like it or not, are only voting for the Democrats because it's not Trump, and that's maybe what some segments of the population are looking for?
That could be the case. In fact, we saw that in the convention last week, very much on Joe Biden as an empathetic person, a nice man who has suffered in his own life and understands the suffering of others. We saw an assault on Trump's character, an assault on Trump's handling of the pandemic, but actually not a lot of confidence in the policy message, which is a pretty progressive policy message and probably not as calibrated to middle America as the rest of the Democratic convention was.
Jim, thanks for the briefing. Just wonderful. Jim Lucier, of course, with Capital Alpha Partners. Love having him on a policy analysis. You've got some other voices coming on surveillance today and through the week as well. Our convention coverage, the Republican National Convention. How about tonight, 9 p.m., the First Lady scheduled to speak, I believe as well. That will be most interesting. Look for that at 9 p.m. tonight. Now with our First Word News in New York City, here's Ritika Gupta.
Thanks, Tom. It's a rare reversal for the Food and Drug Administration. Commissioner Stephen Hahn has backed off his claim that an experimental therapy had provided a dramatic benefit to coronavirus patients. At a press conference with President Trump, Hahn had said that blood plasma from survivors of the virus could save huge number of lives. Hahn now says he misspoke. In Wisconsin, a second night of violence between police and protesters. That's after a black man was shot by police in an incident caught on video. Police fired tear gas to try to disperse crowds. Wisconsin's governor deployed 125 members of the National Guard. Tropical storm Laura is set to become a powerful hurricane before making landfall Wednesday along the northwestern U.S. Gulf Coast. The storm poses a threat to the region's oil and natural gas infrastructure. Energy companies have shut down 82% of the oil output and more than half the natural gas production in the Gulf of Mexico. And Hong Kong will relax social distancing rules starting Friday. People will be allowed to eat at restaurants in the evening, and they can remove masks when exercising outdoors. Movie theaters will also be reopened. Hong Kong reported just 7 new locally transmitted coronavirus infections yesterday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Anna.
Thank you so much, Ritika. Greatly appreciate that. It's not that he's a congressman from Arkansas, and French Hill could never say this as well. Coming up, a conversation on Razorback football. How about that? Bruce Westerman, Razorback from Arkansas, in the 6 o'clock hour. This is Bloomberg. Good morning.
I'm Anna Edwards in London with Tom Keane in New York. You're watching Surveillance on Bloomberg TV. The billionaire Jack Ma's Ant Group has filed for an IPO in Hong Kong and Shanghai. The simultaneous listing could mark one of the biggest debuts in years. Bloomberg's Lulu Chen joins us now from Hong Kong. Lulu, just how big could this get?
Well, Anna, the Ant Financial empire, Ant Group empire, is really the crown jewel of Jack Ma's entire e-commerce and fintech conglomerate. And right now, what we're told is that the company could raise as much as $30 billion in an IPO, dual listing in Hong Kong and also Shanghai at the same time. What that means is it could surpass the world's biggest IPO in history, Saudi Aramco's $29 billion IPO, and the company is targeting a valuation of $225 billion, according to people familiar.
Lulu Chen, what is the significance of a change to Hong Kong to the U.S. underwriters, not in Shanghai, but in Hong Kong? J.P. Morgan, Morgan Stanley, and Citigroup. How do they delicately trace this initial public offering, given the Communist Party assertion in Hong Kong?
That's a really interesting question, Tom. So right now, it does seem that Ant has intentionally decided not to go to the U.S. It's also it's great timing because right now what we're seeing is a bunch of U.S.-listed Chinese companies also weighing whether they want to delist from the U.S. stock exchanges and come and list in Hong Kong because of the scrutiny the Trump administration is placing on Chinese technology companies and also issuing warnings that U.S. endowment funds, for example, need to sell their stake out of these Chinese companies. In Hong Kong right now, companies are just not getting the same level of scrutiny. I think it is the Chinese government's intention to really prop up Hong Kong and also its own star market in Shanghai as an alternative to tech listings and also Chinese companies' IPOs.
And the geopolitics, of course, might influence the strategy of a business like this going forward. Ant Group, I understand from your story this morning, has had to put a limit on its plans to expand in the United States as a result of geopolitics. Where does the growth come from then? What is the pitch that Ant Group will be taking to investors in terms of how big it can be?
Yeah, Ant really shifted away from the U.S. expansion strategy. Also, basically hand in hand with Alibaba's shift away from the U.S. as well. Right now, I think the company is very focused on competing domestically against Tencent. They're not only focusing on fintech, but they're also trying to become an online mall for everything from loans to travel services to food delivery. And also Southeast Asia is another huge area that they're looking at. They've invested in 9 local startups that focus on digital wallets. So that's a huge area that we need to watch out for.
Lulu, thank you so much. Late in our evening, Lulu Chen from our Hong Kong News Bureau. Thank you so much on Alibaba. Coming up to advance the discussion on China, lots to talk about here, even with the distractions of a busy August. Carla Freeman will join us from the Johns Hopkins Foreign Policy Institute. Dr. Freeman, always interesting. Equity markets lift, futures up 13, Dow futures up 161. It's a Salesforce Dow, an Amgen Dow, back in the Dow, Honeywell International. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get your Bloomberg Business Flash. PIMCO says that gold's rally isn't over yet. Commodities portfolio manager Nicholas Johnson says it has room to extend gains while real interest rates remain low. Gold set a record above $2,000 an ounce earlier this month. It's given up some of that increase, but is still up 27% for the year. One of Wall Street's most bearish strategists has conceded. Tobias Levkovich of Citigroup has raised his year-end target for the S&P 500 from 2,900 to 3,300. Levkovich cites what he calls unbridled Federal Reserve easing and negative real rates and the breach of technical resistance levels. And Disney is leading America's old media giants in making money from streaming. According to Macquarie Research, Disney will generate $11.2 billion in direct-to-consumer revenue this year. That's almost 20% of total sales. The Disney Plus streaming service has already attracted more than 60 million subscribers. And that's your Bloomberg Business Flash. Tom Anna.
Ritika Gupta, thank you so much. It is always interesting and entertaining to speak to Mr. Cooperman of Omega. He was on fire yesterday, probably because he was so casual from some island off in the Bahamas. I don't know, it's north of where the hurricanes are. Here's Mr. Cooperman, his criticisms of the Fed.
They have created a real speculative bubble, in my opinion. I have to admit that I'm uncomfortable at the present time not because of the virus. It's a factor. I'm uncomfortable because I'm focused on something the market isn't focused on, and that is the amount of debt that's being created. Who pays for the party when the party is over? You know, we just celebrated our 244th birthday, and basically it took us 244 years to go from zero national debt to 21 trillion. We'll probably end this year at 27 trillion. That is a growth rate in debt far in excess of what the economy is growing at. And I think that that's going to be a problem down the road.
Yeah, well, back in...
And I think they've created a real speculative environment. You know, I was just looking, to give you some statistics. Apple announced their 4-for-1 split on July 30th. The 20-day average call volume at that time was 721,000 calls. Okay, this past Friday, Apple traded 2.1 million calls, 3 times the average of 20 days. Okay, and the stock is up 17% since the announcement of the split, and that's before this morning. Tesla announced their 5-for-1 split August 11th. Same thing, big increase in call volume. The stock is up 49% since the stock split was announced, against the S&P up 1.9%. Now, the last time I checked, if somebody gave me 5 singles for a $5 bill, it didn't create any wealth.
Right,
okay?
well,
it did not create any wealth.
That was the old calculation. Now this is the new calculation when you've got a big component of Robinhood investors. That's sort of one theory out there. What's riskier right now, the high-flying stocks or bonds?
Well, I think no question that bonds, to me, present a return-free risk. And that's what's working in favor of the stock market. What I have not fully appreciated is what a zero interest rate environment does for stocks. I was focused on the fact that we've had zero interest rates in Japan and Europe, and their stocks are 5 or 6 multiple points below the United States market. So I think low interest rates are indicative of a problem economy. You know, we've had artificial support for the economy since 2008. You know, it's 13 years. And I don't look at that as being a positive. I look at that as possibly being a negative. You're Stephen Ratner, close to Mike Bloomberg, who I have enormous respect for, basically wrote an article this morning in the Times op-ed piece, the economic recovery that isn't. You know, I think that the zero interest rates is creating a very speculative tone to the market. I have said for months now that we're really dealing with 3 markets, not one market. The first market is the FANG market. And frankly, these are very fine companies, these technology companies whose demand has been pulled forward by at least 5 years due to the virus. They're not cheap, but by the historical standards of the Nifty 50 of 1972 and the technology bubble of 2000, they're not in any way expensive. And people could conjure up whatever they want to conjure up.
Into the world of Stephen Ratner, you learned at Columbia Business School of a 60-40 or a 60-30-10 efficient market and proper asset allocation. What is the Cooperman theory, given the distortions that we have now? Can you stay with original investment science, or do you have to invent something new for the next 10 years?
Look, I'm 77 years of age. I have no clients. I retired at the end of 2018, and I do what makes me comfortable. Right now, I have very, very, very few bonds. I think bonds represent a return-free risk. And I was beginning to explain to you, there's three markets out there. There's the FANG market, richly appraised, but not ridiculously appraised, okay?
Yeah.
Then the Robinhood market, which is ridiculous, totally ridiculous. Regrettably, I said this on TV about a month ago, that market would end in tears, and the very next day, some young man who lost $70,000 day trading committed suicide. Okay, Carl Icahn is as bright as they come. He liquidates his position in Hertz at 72 cents a share, and 3 weeks later, he's trading at $5. And you check into what's going on, it's on the Robinhood platform. Eastman Kodak, Robinhood platform. Tesla, Robinhood platform. So, that's going to end in tears. I have no interest in that market. It's not rational to me. I don't spend time on it. The third market, there's things to be done, and that's everything else.
And we hope Mr. Cooperman will be safe given Hurricane Laura coming down in the tropics right now. We got much more coming up. Futures up 13, Dow futures up 160. This huge conundrum of what will happen with small cap, mid cap. Can they really switch over from the tech dominance that we've seen? That's really been humbling in the last couple days as tech surges. NASDAQ Composite, 11,659. Coming up, must watch David Sowerby of Ancora. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revisions.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it, that makes me confident that we are going to do everything we can to determine safety.
This morning, 100 years ago, American beet sugar, it was dropped from the Dow. In 2020, it is Exxon that's shown the Dow door. The new Dow, it is digital dominance. Amgen, Honeywell, it returns. And Salesforce.com, equity surge higher this morning. It will be a virtual Jackson Hole. Chairman Powell, he will speak and rationalize a growing negative real yield. And, well, it was not that freshman year in college Western Civ course, you know, the one you slept through. Republicans line up for, quote, the bodyguard of Western civilization. Good morning, everyone. Bloomberg surveillance from New York, from London. Anna Edwards holding court in London over Francine Lacroix. She is on a much-needed break. Anna Edwards, we were talking to Holger Schmieding earlier about Germany. What an interesting position Germany is in. The distractions of Greece and Turkey. I mean, it's really something out of the history books.
Yeah, and even if you just look at the economics, that's interesting enough, Tom. We've got the GDP numbers showing a near 10% contraction in that economy, which is awful, obviously, but relatively good compared to some other parts of Europe. Didn't lock down as much as some other parts and managed to get the test and trace process going very efficiently. We have a slight sense of rising business confidence as well, and now talk of extending their furlough scheme out for another year to those hardest hit parts of the German economy.
Completely different than the United States. A dialogue on furlough and income substitution over there versus what we see in America. With a briefing, our First Word News, here's Ritika Gupta.
Morning, Tom. And President Trump and speakers at the Republican National Convention put a positive spin on Trump's handling of the coronavirus pandemic. The president thanked frontline responders and said the virus is going to be fading. And others warned what would happen if Joe Biden is elected.
There's more work to do, but there is a light at the end of the tunnel. Job gains are outpacing what the so-called experts expected. But Biden's radical left-wing policies would stop our economic recovery cold. He's already talking about shutting the country down again.